So Barry, which is going to be most important of all those big event risks?
Yeah, when you think about it, the Fed is probably the most important factor in the market. But there are four things about the Fed that have really concerned me. One is I don't know if they adequately appreciate the fact that the neutral rate is where they are now, and if they go above it, they are actually tight. Their policy has diverged from the rest of the world. They've been tightening for about 4.5 years. It's not 3 years since Janet Yellen's first rate hike. It's 4.5 years since the middle of QE3 taper, if you look at the numbers. And then lastly, but not least, the causality now runs from the markets to the economy. And I think that they really need to step back and realize that they've done quite a bit in a short period of time, and it's time to pause.
So Wasif, what does an investor do with that, with the Fed, the markets, and so many folks on Wall Street like Barry saying that the Fed is missing something?
Right. Well, I agree with Barry, Sarah. I think he's absolutely right that we're pretty close to neutral, and the Fed, I think, is beginning to realize that with the market reaction function coming through. So I think the market's getting that confidence that the Fed's New Year's resolution is going to be to not raise interest rates with the degree that they were going to. In fact, they may actually not raise at all in the coming year, given what's going on. So I think in real time, they're adjusting to that. In terms of what that means for portfolios, I think what's going to happen is if the Fed does what we think it's going to do, which is take that break and pause, you're going to see a rally much like you saw in 2016, where the more value-oriented, the cyclical-oriented, the non-U.S. markets, such as emerging markets, had a really strong function to that and strongly outperformed. So we think that those markets outside the U.S., such as emerging markets, as well as some of the value-oriented sectors that have been punished over the past year, should outperform if the Fed does take that break.
Barry, you're looking for a pretty decent gain in 2019 for the S&P, 2750. How are we going to get there?
Yeah, we're actually towards the very low end of the Wall Street average of strategist at 2750, and that's a 10% gain. But I do think it's achievable, and as my other guest there pointed out, I do think the Fed will pause. If they do, then what they would do is come down to where the interest rate futures already are. And so the interest rate futures would indicate that they stop, and much like 2016, you could have a rally. The only thing I have a concern about is I don't think the Fed realizes they've already locked in a U.S. slowdown, much lower earnings estimates. I'm at $166 in 2019. The street is still at 173 and too high. So they've already locked down a slowdown in earnings and growth, and that's going to impact the upside in 2019.